You know that frustrating feeling, right? You've bought into a fantastic company. The stock has had an absolutely incredible run-up. But then it just stops. It hits this invisible ceiling, pulls back a little bit, and just starts moving sideways. You still believe in the company long-term, sure, but sitting on those idle shares while you just wait around for the next breakout, honestly, it can be downright aggravating.
Well, welcome to The Explainer. Today, we're diving into the absolute perfect solution for that exact frustration, generating income with covered calls. This is an incredibly popular strategy that literally lets you get paid while you wait for your stock to make its next move.
Here's our quick roadmap for today. We've got 1. The covered call concept. 2. Decoding the options contract. 3. Weighing pros and cons. 4. Step-by-step trade execution. And 5. Navigating the trade outcomes. Let's get right into it.
Starting with Section 1, the covered call concept.
So at its core, a covered call is fundamentally an income strategy. Think of it kind of like renting out a piece of real estate that you already own. You're entering into a contract where you agree to potentially sell 100 shares of a stock you currently hold in your portfolio at a specific, predetermined set price. And you might be wondering, why would you agree to that? Well, because in exchange, another trader pays you an upfront cash payment right now, today.
If the term covered call sounds, a bit too overly financial, let's just use a simple phone call analogy. Imagine the person who bought your contract picking up the phone and saying, "Hey, I'm calling you out on our contract. I want to buy those shares for $390. And because you already own those 100 shares sitting right there in your account, your simple, totally stress-free reply is just, "No problem, I've got you covered." You're covered because you physically hold the actual asset in your portfolio. Simple as that.
Moving on to Section 2, decoding the options contract.
Let's set the stage here with a real-world setup from the thinkorswim platform, looking at Broadcom. Let's say you bought 100 shares of Broadcom a while back. It's had a beautiful run-up, right? It's currently trading at $364. But looking at the chart, you kind of feel like it's bumping its head against a price ceiling right around $390. You're expecting it to just hover below that ceiling, maybe taking a breather for the next few weeks.
So we're going to write an options contract based on those exact expectations. There are 3 main pillars to this contract. First up, the 100 shares of Broadcom you already own. Second is the strike price. This is basically your deal line, the price you agree to potentially sell your shares for, which we're setting right at that $390 ceiling. And third, the expiration date. We're picking a contract that expires in exactly 18 days. We aren't locking ourselves in for years here. It's a very short, highly defined window.
Now here's where it gets really fun. Notice this large premium number. Because you're offering up your shares, the buyer of this contract is actually willing to pay you a premium of $6.10 per share for the right to buy your Broadcom stock at $390. And since options contracts are bundled in lots of 100 shares, that $6.10 instantly puts $610 into your account. Boom! That cash goes right into your balance today.
Let's look at Section 3, weighing pros and cons.
Before we sign on the dotted line, let's balance the scales and be totally transparent about the trade-offs. On the pro side, you generate $610 of immediate, guaranteed upfront income. Plus, if the stock drops slightly over the next 18 days, hey, that $610 gives you a nice little buffer against the downside. But on the con side, you have explicitly capped your upside. If Broadcom unexpectedly rockets to $410 next week, you are contractually forced to sell your shares for $390. You'd completely miss out on that extra top-end growth. So the core takeaway is this. You get guaranteed cash today, but you cap your maximum potential profit tomorrow. Make sense?
Okay, Section 4, step-by-step trade execution.
Now, before we start clicking buttons, we've got to bust some jargon. When you open your trading platform, you're going to be presented with something called an option chain. Forget the intimidating Wall Street name. It is simply an advertising bulletin board. That's it. It's just a digital list displaying all the available options contracts with different dates and strike prices that buyers and sellers are haggling over. Let's walk through the exact 4 button clicks you need to actually execute the trade. First, navigate to the Trade tab and open that option chain for Broadcom. Second, scroll down, select your desired expiration date, so 18 days away, and find that $390 strike price column. Third, to actually sell this contract, you just click the bid price, which is our $6.10. And fourth, you send it as a limit order just to make absolutely sure you get that exact price or better. Oh, and one super vital reminder here, you don't need to hunt for some magic covered call button. As long as you sell this call in the exact same account where your 100 shares are already sitting, the platform automatically pairs them up.
It knows you have the shares covered.
Actually, there is one more reality check number to keep in mind, and that's the cost. Transparently, Charles Schwab charges a simple, flat fee of $0.65 per options contract when you trade online. Now note, that is not 65 cents per share, it's just 65 cents total to place this entire 100-share contract. It is a completely tiny operational cost compared to that $610 incoming premium we just talked about. Bringing us to Section 5, Navigating the Trade Outcomes.
So fast forward 18 days to the close of the market on expiration day. We look at the stock price, and there are two primary ways this wraps up. Outcome 1, the stock is above $390. Well, you get assigned. This means you fulfill your contract, sell your 100 shares for $390 each, and take a really nice profit on the stock. And the best part? You keep the $610 upfront premium. Now, outcome 2, the stock stays below $390, you're safe. The contract expires entirely worthless to the buyer. You keep your 100 shares and, yep, you guessed it, you still keep the entire $610 premium. That $610 upfront money is yours forever in both of these scenarios.
Now, I know a lot of new traders get a bit nervous here, thinking they're totally chained to this contract for the full 18 days, no matter what the market does. But honestly, you aren't permanently locked in. Because a stock like Broadcom is highly liquid, if it starts acting wildly, like say it crashes on bad news or rockets up way faster than you wanted, you have the complete flexibility to just jump onto your trading platform and buy yourself out of the contract early to close the trade. You are always in the driver's seat. Which brings us to our final thought. You've seen the mechanics, you understand the clear trade-offs, and we've walked through the literal platform clicks to make it happen. So, are you ready to turn your idle shares into active income? I really challenge you to take a fresh look at your portfolio. Those stalled stocks sitting there doing nothing, they might just be your next great income stream waiting to happen. Thanks for exploring this strategy with me, and as always, keep learning.